Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So I want to start by having you picture a scenario for a second.
Okay, let's hear it.
Imagine you've spent the last, 15 years painstakingly building up this bulletproof emergency fund.
Right, like a massive savings account.
Exactly. And you did this because you survived a brutal financial crash, you lost almost everything, and you swore you'd never get caught off guard again.
Makes sense. Once bitten, twice shy, right?
Right. But then you wake up one morning, you look at that massive pile of safety cash, and you decide to take it all to the casino to blow on blackjack.
Wait, what? Why would you do that?
Simply because your neighbor is getting rich at the tables and, well, you feel left out.
Oh, wow. I mean, that is a pretty radical shift, going from extreme financial caution to just highly aggressive competition.
It is. And according to recent analysis, that exact psychological shift is playing out right now at the very highest levels of the global banking system.
Yeah, it's kind of wild to watch.
So we're talking about the rapid global rollback of what is known as Basel III. And for any beginner investors listening who, might be unfamiliar with the term, Basel III is essentially the ultimate safety rulebook for the world's banks.
Right, it's the post-2008 playbook.
Exactly. After the 2008 financial crisis, global regulators basically got together and forced banks to lock away massive amounts of their own cash in a metaphorical vault.
The logic was pretty simple, right? Like, if the housing market crashes again or loans go bad.
Yeah, then the banks use their own locked-up cash to absorb the losses rather than just collapsing and asking the taxpayers for a bailout.
Right, which we all remember. And, that locked-up cash, from a regulatory standpoint, that's referred to as capital reserves.
Capital reserves, okay.
Yeah. And Basel III was designed as basically a mathematical formula for absolute systemic safety. The bank cannot touch that reserve money.
So it's just sitting there.
Exactly. They can't lend it out. They can't invest it. They definitely can't use it to pay dividends to their shareholders. It is dead money serving purely as a shock absorber.
Oh, okay, a shock absorber. But as the current data clearly shows, the era of prioritizing that shock absorber is, it's ending.
Oh, it's absolutely ending. The new priority is industrial dominance.
Right. Which brings us to the mission of our deep dive today. We are going to explore how the United States, particularly right now under the current Trump administration, is aggressively leading this charge to basically shred the old safety rulebook.
Yeah, they are moving fast.
And we'll look at how Europe is desperately bending its own rules just to keep up. And most importantly, we will translate all of this high-level banking policy to explain exactly what it means for your personal investment portfolio.
Because it does impact you. And, to understand the sheer scale of this global shift, we really have to start at the epicenter.
The U.S.
Right, the United States is setting the pace for all this deregulation. If we look at the regulatory data from March 19th, the revisions to the American banking capital framework are just staggering.
How?
Well, back in 2023, the plan was to implement double-digit increases in capital requirements. Yeah. Regulators wanted U.S. banks to lock up even more cash.
Right, double down on safety.
Exactly.
Yeah.
But now, we are seeing a complete 180-degree reversal.
Okay, so let's get into the actual numbers here, because how much of a reduction are we really talking about?
So the recent figures dictate that large Wall Street banks will see their capital requirements drop by an average of 4.8%.
Okay.
Large regional banks will see a 5.2% drop. And for banks with under $100 billion in assets, they're looking at a massive 7.8% drop in the amount of cash they're legally required to hold in reserve.
Wow, 7.8%.
Yeah. Federal Reserve Chair Jerome Powell announced 3 separate rule changes simultaneously to facilitate this. Reuters literally referred to the move as a, quote, stunning victory for Wall Street.
A stunning victory. Okay, but let's break down the mechanics of why Wall Street considers, a 4.8% drop to be a stunning victory. Because to a layman, 4.8% doesn't sound like a lot.
Right, it sounds like a rounding error.
Exactly. But according to estimates from Morgan Stanley, this specific rule change means that total excess capital for 36 of the biggest U.S. banks will hit $320 billion.
Yeah, that's with a B.
Right. And that represents a 20% jump, which instantly frees up an extra $54 billion.
It's massive.
So walk us through that. How does a single-digit percentage drop in a requirement translate to $54 billion of freed up cash?
So, it all comes down to the mechanics of financial leverage. Banks do not operate on a one-to-one ratio.
Okay.
When a bank holds $1 in reserve, they use that single dollar to justify lending out or investing 10, sometimes $15.
Oh, I see. So it's a multiplier.
Exactly. So when the Federal Reserve lowers the capital requirement by just 4.8%, they're unlocking the base layer of that pyramid. That $54 billion is the foundational cash that was previously trapped in the vault.
And now they can touch it.
Right. Once it's unlocked, banks can immediately deploy it. They can issue new high-yield loans, pay out massive dividends to their investors, buy back their own stock to artificially inflate the share price.
Which Wall Street loves.
Exactly. Or they can just go on a shopping spree and acquire other companies.
Okay, so if I'm an everyday investor looking at my portfolio, it sounds like the government just handed every U.S. bank a blank check. So does this mean every single bank stock is a guaranteed winner right now?
Well, no. It's actually a highly specific reshuffling of winners and losers. It's based entirely on exactly how a bank makes its money.
Okay, give me an example.
So, despite the overall rollback of the rules, JP Morgan will actually see a 4% increase in its capital requirements.
Wait, an increase? I thought everyone was getting a cut.
Not everyone. And this is because of the incredibly complex, globally interconnected way JP Morgan operates. Regulators still view their specific footprint as carrying higher systemic risk.
Got it.
On the other hand, banks whose business models are heavily focused on trading and investment banking,
Like who?
institutions like Goldman Sachs, Citi, and Morgan Stanley, they are perfectly positioned to reap massive rewards. The rules are being loosened specifically in the areas where those banks operate.
Okay, so that paints a really clear picture of the U.S. landscape. Basically, the Americans are taking off their heavy armor so they can sprint faster.
That's a great way to put it.
But capital is fluid, right? If an investor can get a much higher return from an American bank because that bank isn't bogged down by the strict Basel III safety rules, that investor is going to pull their money out of Europe and move it to New York.
Exactly. Which forces the rest of the world to react. They can't just sit there.
Right.
Europe is quietly bending its own rules simply to survive the onslaught of American deregulation. Like the Bank of England recently announced that for the first time since the 2008 crisis, they are officially dropping their headline capital requirement from 14% to 13%.
But again, to a beginner, a 1% drop sounds like a rounding error. Why does going from 14% to 13% actually matter?
Well, because of that same leverage mechanism we just discussed. When you apply a 1% reduction across an entire national banking sector that manages trillions of dollars in assets.
Oh, right, the multiplier effect again?
Exactly. You are suddenly freeing up billions of pounds in fresh leverage. And the regulators in the UK are being completely transparent about their motives here.
What are they saying?
They're officially citing resilience, growth, and innovation as the reasons for the cut. They are actively acknowledging that if they enforce strict safety rules, their banking sector will just stagnate.
Wow. And the European Union is facing the exact same pressure, but from looking at the research, it seems their approach is a little bit more bureaucratic.
Yeah, the EU is utilizing a much more opaque strategy. They're actively delaying a specific set of market risk rules known as FRTB for 3 full years.
Okay, FRTB, what does that actually do?
So FRTB essentially forces a bank to hold reserve cash against the daily hour-by-hour fluctuations of their trading desks. It's strict. But to get around implementing this rule, European regulators are applying what they call a temporary multiplier.
Okay, let's unpack that. What is a temporary multiplier in this context?
It is essentially a mathematical trick. It's a formula the regulators apply to artificially neutralize the financial shock that the new safety rules would cause.
So they're pretending to follow the rules while tweaking the math in the background.
Precisely. And the European Commission officially stated that they're using this multiplier explicitly to protect EU banks' international competitiveness against the U.S.
Wow, they just came out and said it.
Yep, they are trying to thread the needle,
Yeah.
keeping enough of the Basel III safety language intact so they don't look completely reckless, while quietly loosening the underlying math so their banks can still generate enough profit to actually compete with Wall Street.
So Europe is quietly dropping weights out of their backpacks to survive the race. But what happens to a country whose entire national identity and, their global brand is built on never, ever bending financial safety rules?
Ah, Switzerland.
Right. That brings us to the crisis happening right now in Switzerland.
Yeah, the situation in Switzerland is like the ultimate stress test for the global banking system right now. To really understand the tension there, we have to look back at the recent collapse of Credit Suisse.
Which was a massive deal.
Huge. That wasn't just a bank failing. It was a foundational trauma to the Swiss identity. The entire Swiss brand is built on absolute ironclad financial stability.
Right. You never hear anyone use the phrase as risky as a Swiss bank account.
Exactly. It's an oxymoron. So to prevent another catastrophe that could realistically bankrupt the entire country, the Swiss government is attempting to force their one remaining megabank, UBS, to fully capitalize its foreign subsidiaries.
Meaning what exactly?
They want to guarantee that if the global markets crash, the Swiss taxpayers will not be left paying the bill. But enforcing this demand adds a crushing $20 billion in extra core capital burden directly onto UBS.
Okay, wait. Let's explain what a core capital burden actually means mechanically for UBS.
Sure, core capital is the purest, safest form of money a bank has. It is shareholder equity. It's not borrowed money. It is their own actual cash.
Okay.
So the Swiss government is telling UBS they have to take $20 billion of their own cash and lock it in the vault, completely idle.
Wow. Going back to our analogy, it's like the Swiss government is forcing their Formula One driver to weld a massive heavy steel roll cage onto their race car.
Yeah, that's exactly what it feels like for UBS.
And the government says it's to prevent a deadly crash like the one they had last season. But the driver, UBS, is screaming that the heavy cage makes it literally impossible to keep up with the Americans who are, taking the brakes off their cars.
They can't compete with all that extra weight.
Right. But here's my question. Doesn't Switzerland hold all the cards here? I mean, UBS needs that famous Swiss brand of safety and neutrality just as much as Switzerland needs UBS. Why doesn't the government just, call their bluff?
Well, because UBS has grown into a global behemoth that really transcends Swiss borders at this point. If the government pushes too hard, UBS could simply relocate its highly profitable trading hubs and executive operations to New York or London.
Where they don't have to deal with the roll cage.
Exactly, where the regulatory environment is far more welcoming. And if that happens, Switzerland loses massive amounts of tax revenue, high-paying jobs, and its status as a global financial capital.
That's a huge threat.
It is. And the intense lobbying from UBS is already working.
Yeah.
The Swiss government is now offering a softer line on specific accounting technicalities.
Like what?
Things like how they treat software values and deferred taxes, just to reduce that $20 billion burden. The political pressure is so intense right now that the final decision has actually been delayed until August.
This all paints such a fascinating picture of global financial warfare. But we need to translate this high-level international policy into everyday market reality.
Right. What it means for the listener.
Yeah. For the beginner American investor listening right now, why does this matter to their wallet? We constantly hear the term return on equity, or ROE, thrown around as the main reason bank stocks might go up because of these changes.
Wow.
Walk us through how deregulation actually boosts a bank's return on equity.
Okay, think of return on equity like flipping a house.
Okay, I'm with you.
Imagine you buy a house for $100,000. If you use $100,000 of your own cash as your equity and sell the house a year later for $110,000, your return is 10%.
Straightforward.
Right. Now, imagine you buy that same house, but you only use $10,000 of your own cash, and you borrow the other $90,000 from a lender.
Okay.
When you sell the house for $10,000 profit, you just doubled your personal $10,000 investment. Your return on equity is now 100%.
Oh, wow. So by using less of their own cash and more borrowed money, the percentage return looks massive.
That is exactly what the banks are doing. Basel III forced them to use a lot of their own cash to do business. By rolling back those rules, the banks can use less of their own money, rely more on leverage, and instantly boost their profit margins.
And what do they do with those profits?
Well, that translates directly into bigger dividends and massive stock buybacks, which drives the stock price up. So in the short term, this is an absolute sugar rush for bank stocks.
A sugar rush. But the data also warns about the long-term systemic risk premium rising. What is the actual dark side of the sugar rush?
Right, because there's always a catch. When regulators loosen these capital requirements, they often do it with the unspoken expectation that banks will use that freed-up cash to buy more government bonds.
So they're funding the government.
Exactly. It helps the government fund its own debts. And it sounds safe on paper, but it heavily exposes the bank's balance sheet to market risk.
How so?
If inflation spikes again, or if the value of those government bonds suddenly drops, the banks no longer have that massive Basel III cash cushion locked in the vault to absorb the losses.
They already spent it on dividends and buybacks.
Precisely.
Man. And we also have to factor in the shadow banking sector. Because looking at the data, how does an obscure, unregulated market actually pose a threat to the traditional banks holding our checking accounts?
I like to use a power grid analogy for this one.
Let's hear it.
Imagine your home is connected to the main city power grid. It feels safe, right?
Sure.
But then you find out your house shares a direct electrical line with a neighbor who is running a massive, completely unregulated, highly volatile Bitcoin mining operation in their basement.
Oh, no.
Right. If their basement equipment shorts out and catches fire, the electrical surge travels right back through that shared wire and burns your house down, too.
Wow, and the banks are sharing a wire with the shadow markets.
Exactly. The shadow banking sector includes things like private credit markets, hedge funds using extreme leverage, and high-frequency trading firms. They operate without the strict oversight of traditional banking.
But they need funding.
And that's the shared wire. The traditional banks provide the funding, the electrical wires, to those shadow entities.
I see.
Because American banks are now being deregulated and unleashed to interact more freely in the pursuit of higher yields, a small accident in a dark corner of the hedge fund world can surge right back through the shared wires and ignite a fire in the main banking system.
Okay, so as a beginner investor trying to make sense of all this data, what is the actionable takeaway here? Because I obviously can't log into my brokerage account and calculate a mega bank's exposure to shadow hedge funds.
Right. No one can.
So should I just buy into the sugar rush or avoid the banking sector entirely?
The most important takeaway for a beginner investor is to not chase individual bank stocks simply because you see a headline about deregulation.
So don't just buy the hype.
Exactly. It is very
Right.
tempting to see that $54 billion in freed up capital and try to pick the one bank that will issue the biggest dividend. But as we discussed, the underlying safety floors are being removed.
So a stock might go up, but not for the right reasons.
Right. A stock might surge because of a massive stock buyback program, not because the bank is fundamentally healthier or safer.
So it's about recognizing the macro trend without gambling on the micro players.
Focus on broad diversification. You have to understand that we're entering a period where the global financial system is inherently carrying more risk than it was 5 years ago.
That makes a lot of sense.
When you see bank profits soaring in the coming months, recognize that it is largely a regulatory sugar rush driven by leverage, not necessarily a miracle of sustainable economic growth.
Right.
Keep your portfolio balanced across different sectors,
Yeah.
like technology, healthcare, consumer goods. That way, if that shadow banking fire does surge through the wires, your entire life savings isn't sitting in the one sector that just dismantled its fire alarms.
That is incredibly practical advice for navigating a really complex shift. So to briefly recap the journey we've taken today, the United States is actively dismantling the old Basel III safety nets to unleash its banks and financially dominate the global market. Europe and the UK are nervously tweaking their own rules, dropping weights just to keep pace and prevent capital flight to Wall Street.
Exactly.
And Switzerland is caught right in the middle, agonizing over whether to protect its citizens from another crash or let its biggest bank run wild to stay relevant.
It's a tough spot to be in.
It really is. We are officially operating in a world where competing globally is prioritized over absolute financial safety.
The core philosophy of global finance has fundamentally changed. Basel III is no longer viewed as a mathematical baseline for security.
It's basically a tool now.
Exactly. It has been transformed into a flexible tool for industrial policy.
It is a profound shift, and it leaves us with a lot to consider as we manage our own financial futures. I want to leave you with a final chilling question to ponder as you look at your own investments this week. Markets are inherently cyclical, right? Crashes are a feature of the system, not a bug.
That's the truth.
So when the next global financial crisis inevitably arrives, we won't be asking why the market turned. We'll be asking if the massive defense walls we so eagerly tore down today would have been enough to save us tomorrow. Don't forget to subscribe and hit that like button.